Hello and welcome to focusIR. I am John Human, and thank you all for joining us for today's special roundtable on what is one of the biggest technology trends in the world today, data centers. You've heard a lot about AI, but really the power behind this incredible technology is the infrastructure, the data centers that run it. It's a huge topic to navigate, and with that in mind, we've assembled a panel with deep expertise from across the value chain, from the hardware behind it, the infrastructure and the applications that run on it, and of course the power that's needed to run it, which you may have heard lots and lots about. So, to kick us off, we've got lots to cover, but I think perhaps the best place to start, if our panellists can introduce themselves. Let's start in what's my top left-hand corner, Mark Lebel.
Hi there, I'm Mark Lebel. I'm a senior analyst at UEM, which is Utility Emerging Markets Trust. We're a FTSE 250 listed investment trust. We've been running for over 20 years, and we invest in emerging markets infrastructure, listed companies in infrastructure, and about 20% of our portfolio is in what we call digital infrastructure, which includes data centers, fiber, telecoms, and we're also exposed to the electricity side of things, of the energy transition, which I'm sure we'll talk about as well, has moved more to more electricity, renewables, etc.
Absolutely, thanks, Mark. Mark Yeeles, going clockwise.
Yeah, thank you very much, and thanks for the invitation, John, first of all. So Mark Yeeles, I have been at the forefront of technology and the technology stack into data centers, both from a power and automation perspective for quite some time. And prior to that, I guess I was the other side of the fence, actually, using all the data that came out of this data center world in robotics and software. So yeah, hopefully I can give a kind of broad perspective on where I see some of the challenges and opportunities this morning.
Absolutely. Lucas.
Yeah, Lucas Arnott. Great pleasure to join the panel here this morning. I work for Xtrackers. Xtrackers is the third largest ETF issuer in Europe. We're really one of those like umbrella issuers that try and cover a lot of different areas of the market. We've of course seen the rise of AI in core products and very established indices around the world. But at the same time, it still remains one of those core areas where there's a lot of thematic investment interest. So we build some of these solutions around AI, around electrification, etc., and engage in broader research with our colleagues on the research side as well when formulating these theses.
Thanks, Lucas. And last but not least, John Q.
Good morning, John. Jean-Hugues Delamaz. I'm a portfolio manager at Redwheel Ecofin. Ecofin has been a specialist of listed utilities and infrastructure for the past 3 decades, and we run notably an investment trust listed on the London Stock Exchange called EGL, Ecofin Global Utilities and Infrastructure Trust, with a consistent track record in investing in listed entities in the utilities infrastructure world, obviously a space which is largely disrupted by data centers today.
Indeed. Now data centers they've obviously been around for a long time, but I think it's fair to say that there's been a real step change in the importance of the data center world to the technology industry. Perhaps Mark Yeeles, you could start us off with this one, because you've been there throughout this period of rapid growth.
Yeah, and I think you're right, John. Certainly in the last 3 to 5 years, you've seen some real acceleration, and I think it's been born out of probably a number of points, actually. Not only are we just seeing the demand grow at an exponential rate, I think it's become part of the world's everyday narrative. So prior to AI becoming 2 letters, nobody would have known what was happening in data centers, or certainly very few. So I think just those 2 very simple letters have brought the technology and the capability into the living rooms of everybody at home, and we can all, let's be clear, we can all dabble in AI as and when we want. And but if you wind the clock back 5 to 6 years, as I say, whilst we were all using it, maybe for our banking, Netflix, and possibly every other part of our lives, I guess the PR aspect of the data center industry was probably doing itself a little bit of a disservice. But I think the growth is going to continue. The demand curve doesn't show any signs of slowing. We've seen that from the hyperscaler investment cycles more recently, and that really does remain the biggest signal, I think, to us all about these multi-year commitments from the big hyperscalers. So I see it continuing along this hockey stick path, and AI in particular, when I think about the headline of AI around NVIDIA in particular, because of all of its global presence, and Jensen can show up at any point and any time and any part of a journal. So I don't see this slowing down anytime soon.
Lucas, I mean, you invest across the value chain. Perhaps sort of talk about what you've seen as the key demand drivers in terms of applications in recent years. Obviously, AI being one of them, but it's a bigger picture than that.
For data centers overall, it's certainly a bigger picture. I would still argue, though, it's really the incremental demand changes that we see coming through at the moment. I mean, overall, the big picture is, for us, AI is still really in this build-out phase. We're only now in this ramp up, right? That's why all the capex is happening. But if you put it into historic perspectives, we're really still at the onset of that trend taking place in portfolios, but of course also in the real world. I mean, only the other day I've read that there's still about 7 billion people in the world that have never even used an AI agent beforehand, right? So like, it's a huge untapped market that comes with its own challenges in terms of the build out. So like, we still feel for data centers, this is going to be the key driver that simply changes a lot of the economics. The physical design now has to shift if we speak about basically more and more power hungry infrastructure. And of course, it's then also all the underlying topics that we see rising of importance. The grid connectivity towards these data centers, for example, that's one of those core elements where there are huge gaps, and companies are now rushing to fill them in one way or the other. But I feel most importantly, I mean, the takeaway for us has always been the last couple of months, this theme of AI, and then also how it spills into data center demand, is a really healthy theme at the moment, and it's in good shape. If we look at the capex cycles that are happening, yes, it's certainly steep plans that companies have. I mean, we're looking at basically doubling capex within just 2 years' time or so. But if you put it more into like historic context and also past innovation cycles, you're looking now at probably about 1% or so of capex, of GDP that's allocated to capex on exactly this AI build out at the moment. That's still relatively modest compared to what you've seen with other huge innovations on the telecom side, etc., that happened in preceding decades. But of course, I mean, the throughput is going to be a bit the critical element here, right? Like, how quickly can we now build out the infrastructure to keep up with all the plans and the spending plans, particularly that the companies have, so that the revenue can come through as well at the end of the day.
Indeed. I mean, it's interesting that you mentioned perhaps the bottlenecks to roll out and sort of grid connectivity and capacity being one, and then that brings us very neatly on to John Hugh. This is exactly where you invest. Tell us about your views on what this has meant for your particular sector of this industry.
Yes, indeed. I mean, what I would say to set up the overall picture is that our energy systems and connections have largely been built in the 1950s, 60s, 70s, so which I would call typically the post-World War II reconstruction era, and are proving largely obsolete, but also no longer adapted. The first disruption that our systems had to go through was the development of renewable energy, obviously, over the past decade. The reason being that historically we used to have one big coal plant, a nuclear plant, interconnection lines bringing power to urban centers. The coal plant typically has been shut down, nuclear largely phased out, and replaced by hundreds of wind farms spread out all over the country. And that's the case in most OECD economies. So that has required major kind of interconnections, developments, and capex over the past decade. But AI and data centers are coming as today the number one bottleneck and challenge, because they are coming at a time of significant scarcity of power generation resources. Again, we've largely phased out of coal. You know, the UK has entirely shut down its coal units over the past 15 years. It's unprecedented. 150 years of coal history and completely erased in 15 years. And most countries have not invested in nuclear. So this is coming at a time when power generation capacity is very scarce, and a lot of baseload capacity, so 24/7 electricity power generation source, has been replaced by intermittent power sources like wind and solar. So this is where the main bottleneck stands, created and enhanced by the very fast development of AI data centers.
Indeed, and it's fascinating. AI is obviously a technology story, and data centers behind them are a technology story, but it's also becoming very much a power story as well. I think it's absolutely fascinating. Mark Yeeles, perhaps talk us through some of the other sort of physical constraints to delivering the capacity required to power the AI revolution.
Yeah, I think it's absolutely pivotal what Johnny Hugh was saying there, and power is clearly one angle, but I also think about the other topic around this, which is skills and people to help us build out some of this infrastructure as well. And if you couple that along with, so you have skills and people and power, which actually is top and bottom of the AI layer cake that NVIDIA published to the market. If you look at that and then you think, well, how are we going to build it out? And then you find out that construction and equipment lead times are also extending and stretching further than they ever have done before, because now we're all kind of caught out with capacity and the ability to build at the rate at which the market demands of us, with a compound annual growth rate. It depends on what report you read, but somewhere between 13 and 19% globally. So I think there's two kind of dynamics there. I think there's, well, how do we build it out, and can we build and construct in a meaningful time, and do we actually have the skill set to enable us to do it? And are we poaching skill set from each other? Well, I mean that by countries and regions to help build out some of these huge programs. So I think they're the other two paradigms, John, for us all to think about and consider.
Lucas, this presumably creates huge opportunity across the value chain, not just in investing in the applications themselves, but everywhere. There are so many aspects.
Yeah, sure. I mean, overall, and we've sketched it out already, right? It's a vast value chain. You could arguably, if you start at, like, say, the critical minerals bit of this whole value chain, where we think about the copper, for example, that we then need to put into the wiring and the cooling systems, etc. And it goes basically all the way to the regulated utility at the end that is then responsible for making sure that the electricity flows neatly, right? So that's the value chain. There's a lot in the middle as well. There's a lot of tech components in the middle. There's a lot of room for efficiency gains in the middle as well. And these sections of the value chain, they behave very differently. And that's why it's quite difficult, I would argue, to build, say, a holistic investment product that was to capture this whole value chain. So the approach that we have taken in the past was always to focus on certain subsegments of this value chain. And I mean, you could probably tell from the way I was explaining it already, we're actually most excited, I think, about this middle section. So where we really look into smart grids, into storage, into some of the efficiency gains that we can make kind of like within the existing grid envelope, right? I think, Mark, you were alluding to it as well. Like, it all takes time, these lead times to connect, say, renewable power, to connect new data centers. We're talking years, if not a decade or so, to get some of this done. While at the same time, kind of like the investment demand and the capacity constraints already now exist. So there isn't really time to wait, let's say. And so we feel that the most profitable companies and some of the most interesting opportunities, they might actually sit right in that middle of the value chain, where simply we're kind of like rewiring a bit what we have, rather than kind of like rebuilding the entirety of the grid. Because I mean, the grid is very slow to change, and it's just the incremental demand at the moment that we need to handle. It's not that like consumption is going through the roof, right? We're talking about adding maybe 2, 3, 4% of additional electricity demand per year now to the grid. It's a huge challenge, don't get me wrong, but it's also, if you look at it from an efficiency and tech perspective, it's something that many companies are pioneering. And so that section we find very interesting.
Yeah, that sounds like there's opportunities in both hardware and also in the actual electricity generation side of things. John Hugh, what sort of solutions are being delivered that will help provide this capacity? 3 to 4%. It doesn't sound like a lot, but in the grand scheme of global demand, it's absolutely huge. What are people doing to deliver this extra power?
Yeah, there are solutions. I mean, and maybe to enhance further the issue of this scarcity of power. You know that we consume about 15% less electricity today in the UK than 25 years ago. So electricity consumption has been declining, and expectations are that power consumption here in this country is going to increase by 50%, 50, in the next decade. So obviously a major challenge, probably a third of that more or less related to data centers. So extremely favorable to incumbents. So I would say the solutions are the following. The first one is that you should expect development of base load electricity generation or development of renewable capability with batteries. So the battery technology is part of the solution. And I would say the development of batteries has been slower than expected over the past decade, I would say, probably because electric vehicles have not developed as fast as expected 10 years ago. But you should expect a big acceleration in new technologies around energy storage and batteries, because that's the way to transform renewable energy, so carbon-free power generation, into as close as possible to baseload. So that's part of the solution. But another key part of the solution, and from our perspective, it's an immediate investment opportunity, is what's going on with the grid. So, you look at National Grid, which has an £80 billion investment program. That is a necessary program, which all the grid operators are launching heavy capex into, and will be incentivized to do so, because governments and regulators are here to make sure that this investment program materializes. So you should expect significant capital allocation into grid, and also positive support from regulators and governments to make sure that the private operators are gaining sufficient returns out of it. So these are the solutions, an acceleration in everything, and grid is at the center for sure.
Yeah, absolutely. It's interesting you mentioned the sort of increased efficiency that's meant that the UK power demand, as one example, has fallen in recent years. Perhaps, Mark, are there sort of developments going on in the hardware side of things that actually will improve the efficiency of data centres themselves to actually bring down the amount of power they require to operate?
Yes, all the time. I mean, I think we need to think about this a little bit more holistically as well. Okay, so when I was thinking about carbon, I often think about embodied carbon within products, within solutions, as well as once they are installed on site. Well, how do they make the facility more effective, more efficient? Because of course the cheapest power you use is the power you don't use, and therefore. How does that make that whole infrastructure, whole system, holistically from end to end, become more effective, more efficient? So I think that there are lots of areas, of course, where companies like my previous employer would be very, very focused on. But also the dawn of AI has given us another leverage point to start to think more carefully about how do we utilize some of the technology. And a fine example of that is in liquid cooling, which has been forced upon us because of the power of the chipset, but it actually makes for a more effective and a more efficient solution as well. So I see technology evolving, and I see the use of power and the production of power evolving as well. I think John Hughes was quite right. The BESS play, and maybe, who knows, we might even get to a nuclear plant at some point, SMR in the future, powering a number of these facilities. There's almost the perfect paradigm and the perfect match here. So yes, in summary, I think technology will evolve and continue to evolve, and I think we'll also think about the way that we supply our data centers, maybe from a different angle in the next 2 to 3 years.
I mean, Lucas, we've talked about semiconductors before as being key to the AI revolution. So how much is the sort of semiconductor revolution a continuing part of this story? NVIDIA is obviously an incredible story, but is there more to come on the semiconductor front?
I mean, if you look at some of the market expectations right now, I would say yes. Right, that's certainly the expectation this year. A lot of these firms have really shifted gears in terms of delivering also strong earnings, and that has made some of these valuations that we have seen in the space over the last couple of years actually somewhat more attractive. So we're at this interesting point where the theme has been running now for kind of like a couple of years. I mean, certainly since the introduction of ChatGPT, kind of it's definitely in the mainstream, but the theme has actually gotten a little bit cheaper over time, simply because we already now see, at least on the hardware side, that these companies are actually also delivering on their plans, and they are rapidly becoming more profitable companies. At the same time, I mean, the role for us on the passive side, when we think about major indices, it's always to look at the representation of these companies as well in existing portfolios. And I think here the storyline, of course, has been very much fundamental in the sense that you have those few chip makers, kind of like the shovel makers of this AI craze now, and they really make up increasingly large portions of the global market portfolio, and hence they feed their way into many of these indices. An MSCI World, for example, that index would be now heavily tilted towards the theme of AI. We would typically say it's about 25% or so of the portfolio that typically rides quite high on this specific theme. And the risk, I feel, is a bit to exactly lose out on like some of these downstream, or like let's call it some of these solution providers in the second row that kind of like help us solve some of those bottlenecks that we have discussed. If we only ever think about the chip makers in the first place to play the theme, there's certainly a lot more, and that has received, first of all, less attention from investors so far, and it's also simply less a component of how portfolios typically look like. I mean, we on our side, we run an electrification solution, so where we basically pick relevant companies from across the board. We look at patent data. It's really one of those more innovative approaches that you can run in a purely systematic fashion. And what we find is that actually these companies, they only make up about 3% or so of the global market cap that we find. So it's a tiny subsegment of the typical investment universe. And if you put that into contrast to kind of like the steep expectations that we have for that segment and the critical role it will play, there's certainly a bit of a mismatch.
Plenty of opportunities there, sort of just below the radar, as it were. Mark Lebel, we talked sort of in very broad terms about demand for AI. What I'd like you to perhaps answer is some of the sort of regional specifics. What is the difference in the emerging market story when it comes to data center rollout?
I think one of the interesting things is that over 80% of the population is in emerging markets in terms of globally. But what's interesting, I suppose, in the emerging markets is that the universe, in terms of hyperscalers, etc., falls into sort of two universes, if you like. There's the sort of US system, which I suppose is the Googles, the Amazons, etc., Oracle, Google, and then you've got the Chinese system, and that's more like on I suppose on the private side, it's more like Alibaba, Tencent, they do ByteDance, and obviously there's a big SOE component, I think, in China as well on the government side. And really between those two, I mean, if you look at figures from like IEA, between those two countries, you've got over 70% of world capacity in data centers. And then if you look outside into other areas, perhaps Singapore, and that's the Singapore cluster, which includes Johor over in Malaysia and across into Batam in Indonesia. Again, who are the customers for that capacity? Typically American and Chinese users. So I think you've got this sort of dual system universe, but in the emerging markets they meet together and they compete head on in different segments of the markets. That's an interesting dynamic, I think there. Outside of that, I mean, you're seeing exactly the same demands as everywhere else, but as I say, the data centers at the moment tend to be in those more developed markets. But there's a big push for some of the other markets to open up. I was at the conference a couple of weeks ago. The Middle East would love to host more international data. They tend to they have Amazon and Google, etc., coming in and investing quite heavily there, but it's more for domestic sovereign data consumption. But they'd love to sort of open up that, the cheap energy that they've got to sort of provide more on a worldwide basis. But I think there are sort of issues around data sovereignty and laws and these kind of things. So the Americans tend to be, investing where they feel comfortable, which is places like Singapore, Australia, and domestically in the US, and the Chinese mostly at home in China. But obviously they're keen on Singapore and some other markets.
John Hugh, obviously, we talked about sort of power bottlenecks, which I guess are sort of a feature of sort of Western grids. Do you see opportunity, for sort of data center growth because of the availability of power, as Mark's alluded to, in other parts of the world?
Yeah, it's very transformative for power generators and a real opportunity. So beyond growth, which we've alluded to, I think it represents an opportunity of a major de-risking of the utilities business model. And let me explain. When Amazon signed a contract for electricity procurement in Pennsylvania in 2024, it's only 2 years ago, it's not that long ago, and it was the first contract of that time. They signed a contract for 17 years with Talon Energy, with a clause to renew it for another similar period. And that means that for the utility, it represents some of the best contracts you can dream of. It gives you the highest possible level of predictability of your future cash flows. You know pretty much the price at which you're going to sell your electricity, the key factors, how inflation is being taken into account, and it's a very long-term commitment where both parties have an interest. For Talon, it's security of their future cash flows. For Amazon, it's the security of their electricity procurements, which, as we know, and we've discussed it, is the number one challenge for most of the tech companies today. So that's the type of contracts which we've seen developing in the US. It's been very much a US phenomenon over the past couple of years, but it's bound to develop into notably Europe, UK, in the next few years. So that, from our perspective, represents a major de-risking for the incumbents, major opportunity. And there's another element which I think is worth highlighting. It's the price of electricity at which those contracts are being signed. If you take the past 25 years average wholesale price of electricity, let's say it's going to be around something like $35 per megawatt hour. Well, those contracts quite typically are signed at over $100 per megawatt hour. So what does it show? Not that the tech companies are out of their mind, but much more that this is a critical matter. There is a massive bottleneck. So there's a race to secure power procurements for those tech operators. So it's a massive, it's a historical opportunity, to be honest, for utilities who have spare power generation capacity. And typically what we want is carbon-free baseload or battery-supported carbon-free renewable energy as well. So this is the critical situation for incumbents and a major opportunity.
I think it's fair to say that we have in recent years struggled to build a nuclear baseload in the UK and the US, but that hasn't seemed to have been the case in emerging markets. Mark, do you think this ability to build and sort of being able to leapfrog perhaps legacy infrastructure is going to prove a key advantage for emerging markets in the data center rollout?
I think it can. I mean, I think you've not so much on the power side, but I think coming back to the point before. I mean, it's interesting that in many ways the data center is going to where the power is before. So I think if you look historically, it's been about connectivity and interconnections. And now in the world of training and AI, it's more where the power is. So say in China, for example, they're very much encouraging, I suppose, more investment in the north and west of China, which is where there is renewable energy, plentiful hydro and particularly wind power. And also it's cooler as well. So you can cool these data centers using sort of ventilation for a large part of the year rather than having to have air conditioning and chillers and cooling. So we're seeing that a lot more. It's interesting as well that people are placing data centers where there's industrial connections. So you're seeing a lot of data centers going on old industrial sites, sort of steel plants. In Scandinavia, apparently paper pulp mills are being used as sites because they've got the water, they've got the electricity, they've got the land. Demand for newspaper has gone down. So we're seeing a lot more of that. In China, it's interesting in that I think there's almost a China speed in terms of the way that they develop things, that things get developed a lot faster. Perhaps the standards aren't quite as high in terms of the specifications, but they have a sort of methods which is, I suppose, a lot more about off-site modular construction, bringing things in very quickly. It may not look aesthetically as pleasing as perhaps in Western markets, but I think there is that sort of can-do attitude in China. Partly through the use of technology, partly this sort of just a sort of mentality, I think. But also, there's obviously more, if you like, I suppose, governmental support for these kind of things, that things get pushed through that in a sort of more Western democracy is more difficult.
Yeah, absolutely. We talked a couple of times about in fact, Mark Yeeles, you did small modular reactors, which are a fantastically interesting nuclear technology, and of course, Jean-Hugh has alluded to batteries and how the technology behind batteries needs to improve to capture renewable power. Mark, perhaps you could give us a feel for where you think we are in the delivery of those technologies to kind of deliver this electricity.
Yeah, I mean, it's an interesting topic, isn't it, John? I think from an SMR standpoint, how close are we? I mean, I genuinely believe within the next 5 to 8 years, we'll see SMR tech, whether it's deployed in the UK or not, might be somewhat more challenging. But I think certain parts around Europe and the rest of the world will see that probably even quicker, John, from an SMR standpoint. From a battery standpoint, we know that's today's world. It just depends on the behind-the-meter enthusiasm and need from the particular developer to make that a reality. So I think we can see both aspects of that. And then we talk about, I think John Hugh started to talk about this, but thinking about where we get our power from. So as the resurgence of PPAs becomes more and more prevalent, and I know through some of the discussions that I've been having with colos and hyperscalers, this is almost normal daily talk, is to say, well, how do we kind of buffer this interim period before we start to move to more sustainable behind-the-meter technologies? So I think I can see that now. But I have to say, I think the SMR tech, I think the US are probably ahead of the curve on this one, mainly because of their vast land availability and then the pressure not to build it next to a housing estate. Might make it a little bit more attractive, and perhaps in the UK and Ireland we maybe need to think a little bit more broadly about where SMR tech could be placed in and amongst our communities. So there's a bit of PR work to do there for sure. But I think in summary, I'd see SMR UK and mainland Europe maybe 6 to 8 years away.
Indeed. I mean, I think I'd like to talk about the opportunities, the investment opportunities that arise as these bottlenecks are unlocked, which it sounds very much like they will be. Just to sort of a little bit of a negative spin before we move onto the positive opportunities. There's a lot of talk about AI overinvestment in recent years. There may be a bit of a bubble. Lucas, perhaps you're best positioned to give us a first view on that. Where do you think we really are? How worried should we be about this being a .com style bubble?
Sure. I mean, it goes back a bit to the points that I was making earlier, right? Where we say right now we're actually at a point in the cycle where we see earnings coming through more and more. So that's, first of all, a very positive sign for investors overall. It just means these companies are actually able to justify some of these valuations that investors paid in the past, and valuations, the metrics as such, they are coming down somewhat. That is positive. The other related topic, I guess, is nonetheless, of course, the role that these firms then play in the portfolio. That's also something that we've discussed already. And I guess what's then fundamental to understanding both of these actually is, and looking at capital market history, it's kind of pretty evident that you have trends and themes in markets that can last for decades, that can really drive returns not only for 5 years. I mean, now everyone's looking back at, say, the US stock market and saying like 3 years, double-digit returns. That's a bit worrying, but you can have episodes like this, and we had many of those in the 50s, 60s, 70s, etc. But what I think was one of the conclusions then from all these episodes is that, yes, the theme might be structural, and we would certainly argue both AI and data centers fall into this very structural category, but it's not necessarily the firms that have driven the theme at the early stages that are the ones then that also will drive the theme throughout. That's simply where you then see a lot of turnover also in major indices. I mean, just the nature that kind of like the simple fact that today's winners are not necessarily tomorrow's winners is something that feeds through how investing works, and also even how big indices work. And S&P 500 has a lot of turnover for that specific reason. If you go back to the dot-com bubble, because you mentioned that, right? I think the only firm in the top 10 from back then that's left is Microsoft, and the rest got challenged. I mean, we're still, you would say, in somewhat the same broader thematic context. It's all quick and rapid technology adoption. Yes, AI is changing with the pace, but there will be these challenger companies, and so that's why for us always it's a bit the difficulty to stay invested in the theme, but actually trying to avoid excessive concentration to some of these single names, especially the ones that have been super successful in the past, where we know, okay, there will be more disruption coming through. I think a perfect illustration is the current IPO cycle in equity markets that we're seeing. The fact that you basically had SpaceX entering public indices now just a few weeks ago, but then also there's talk about OpenAI and Anthropic being two major other IPOs that will come, and they will already or they might already be in that role to then challenge some of these existing hyperscalers and very established firms that have so far kind of like, say, monopolized a lot of the returns and the attention in that theme. So like for us, probably the quickest way to think about it is always trying avoiding a little bit the single name concentration while really thinking about more the thematic exposure that, of course, is, as I think you all agree, is incredibly relevant at the moment.
Yeah, absolutely. Mark Lebel, I mean, obviously, by your very nature as an emerging market investor, you are avoiding those superstar names. Tell us how you sort of manage your exposure. 20% is reasonably concentrated towards data center infrastructure. What are you doing to kind of manage the sort of the risk that there is a slowdown in this particular cycle?
I think the important thing to say with our fund is that we're infrastructure investors. So, we're looking at a very sort of narrow set, I suppose, of universe of companies that have a similar kind of business model, which is a sort of upfront capex and then very long-term contracts often, and you're earning, generating cash flows for 20, 30, 40, 50 years off that infrastructure. And data centers fit into that kind of theme that we've got, but it also applies to things like electricity transmission lines, renewable energy, etc. So we're very much in that sort of, I suppose, concentrated area where you are building a facility, you're securing contracts with the likes of Google or Amazon, and there'll be long-term recurring revenue contracts giving you good visibility into the future. So we're happy with those kind of returns that we're getting, probably sort of low double-digit returns that these companies can achieve. I should also note that we're not investing in projects as such. We're buying listed companies listed on stock markets, so we can play in and out at various times. There will be times where these things sell off. There's been a bit of a reduction, particularly in China, in the last 6 weeks or so it's making things a little bit more attractive from a valuation point of view. But if we think they've gone up and a bit racy, then we can sell out. So across the portfolio, we're really sort of bottom-up investors. So we're looking across our universe of all the different sectors, trying to find the best opportunities for. And as I say, at the moment, it's more of an outcome that 20% of the portfolio is in digital infrastructure. But it's important to say it's not just data centers, that's probably the biggest part, but we're also in telecoms towers, telecoms, mobile phone companies, satellites, fiber, etc. So there's a whole sort of universe there of digitization, from China to Africa, Southeast Asia, etc.
Yeah, absolutely. Jean-Hugh, utilities not often been perceived as a sort of racy, exciting growth sector, but and in fact, in recent years, has at times fallen somewhat out of favour. But this is where you've done extremely well. Talk us through, what is changing in terms of the perception of utilities. Obviously we've known them as defensive investments for years, but now there seems to be a sort of an extra growth element to the sector.
Yeah, you're right, John. I think we're living through structural changes to this specific space of utilities. Historically, they were perceived as either very regulated bond proxies or businesses of power generation which were very merchant driven, so dependent on the pace of commodity prices. So kind of that driven by external factors. So the phenomenon I mentioned earlier, and Mark mentioned it as well, about extension of the duration of those contracts, the PPAs, the power purchase agreements, definitely are structural change to those companies, to their benefit. What I would say is that the way it's illustrated for us as listed investors is in their earnings growth outlook. And Lucas mentioned it. Those are companies which are used to growing pretty much in line with GDP. And in the US now, it's not uncommon to see utilities growing their earnings by double-digit per annum. A lot of the traditional utilities in the US are growing their earnings in the next 3 to 5 years by 6, 7, 8%, sometimes 9%, well higher than the historical typical range. And we're seeing that phenomenon in UK, Europe now. It is accelerating. We're not yet at the growth pace of the US names, but we are clearly seeing an inflection point, acceleration of the earnings outlook potential. This is a game changer. And what I find interesting is that if you look at valuations, with all the phenomena we've been discussing for the past half an hour, you would think that boosting factors to growth and demand, de-risking, higher prices, well, actually that looks good. And if I look at the relative PE multiples of utilities and listed infrastructure overall, they're still trading on the lows, relative PEs. So you haven't seen the significant structural re-rating of that space in listed equities that I believe the improvement in the fundamental outlook would typically justify. So we actually find a lot of attractive opportunities of companies which have been valued as, again, very much as bond proxies and are moving closer to a growth model with obviously very solid defensive characteristics. It's not a tech sector, it's a sector where you have structural growth drivers now.
Yeah, absolutely. Lucas, looking forward, I mean, we've discussed AI as perhaps the key driver of the rollout of data centers, but also that there's a very long way to go in terms of sort of global adoption of AI. What are going to be the things that drive further uptake? We have a lot of fun with AI, but in particular, how is it going to be embedded, do you see, in the sort of the global economy and business to really increase that uptake further?
I mean, it is a structural theme, and simply by nature, it will trickle through businesses, right? That's, I think, the experience that we've had. I mean, going in, I mentioned how there's basically this huge untapped market. I mean, 7 billion people, especially in emerging markets, they've never really interacted with that. I mean, that opportunity alone is super significant. But I think what's important is always to kind of like really take this full value chain perspective. I mean, the same approach that we've really taken now to data centers, where we kind of like think about those front to end, from where the raw material comes from to the utilities just now, is to also think it through on the AI side, right? And so one of these approaches that we've taken in the past already is to identify some of those early, say, adopters of AI far downstream in the business. And they're great examples of, say, US banks, for example, in the financial sector. I mean, it's not a super innovative sector where you were to be thinking, well, AI can really already now move the needle, but it certainly does. I feel it's going to be a lot about these use cases on the business side that's completely underexplored in many areas still. That's where a lot of the incremental demand growth will come from. And it's, to be honest, only on that side also that companies can justify many of these big CapEx projects that are now being announced, right? Because it's still, I mean, at a point where you have to question the monetization down the road. We spoke about the replacement cycles already. I mean, the tech that you put in now is only valid maybe for the next 5 years. It's questionable if it's going to last like more than that. So like we have to really think about the downstream applications already now, and there has to be a little bit of a speed change as well. But then again, we're talking about all those limiting factors, the data centers, the connectivity. I mean, big corporates that have to move quicker, that need to in-house those models. But yeah, this is really where the monetization sits downstream, and where we are just really at the beginning.
Yeah, absolutely. Mark Lebel, I mean, if we think about data centers as this kind of foundational technology, how much does sort of adoption of these sort of next generation digital platforms, AI, factor your thinking when it comes to other investments in the portfolio? Do you look at how companies are embracing these technologies as part of the sort of research case?
I think we do to a certain extent. I think we're at the very beginning of a major change, and I think coming back to what Lucas was talking about is, I think with AI we get a little bit sort of, it's all about chatbots and open AI, but really the story here is about huge amounts of data, huge data sets being collected, and the ability to process that data and then analyze that data, look for correlations, look for trends, look for probabilities of events happening. And I think if you look at AI, narrative is that a lot of the algorithms that we're using, were developed and thought about in the 80s, 90s, early part of this century, but it's only really in the last 10 years that you've been able to scale up at an economic rate to do it. And then over the last 5 years, it's become much more economic to do it again. And now people are looking forward and saying, well, look at the ROI we're getting on what we've just invested, look at what we're achieving. And there's just this almost a mania, I suppose. But how companies can take all of that data that's being produced in their systems and help them run their businesses much more economically, improve customer service, improve fault detection, improve efficiencies of the way their buildings run, etc. So I mean, it's I think we're at the early stage of that, but we are seeing. And some of it's AI, some of it's digitization. In the telecom sector, for example, the number of customer service people that you typically used to phone up and complain about your mobile phone bills or whatever. Now it's all done pretty much with chatbots or online servicing. That saves a lot of money for the data center, the companies. But they can also follow their technicians and where they are. They can rate them. There's a few years back, but one company in Brazil introduced a sort of tracking of their technicians, and customers would rate them, and they found that productivity went up twice. They did twice as many calls a day because they were being tracked and traced and et cetera, et cetera. So I think there's a lot of technology which is making small incremental improvements to a lot of the companies in our portfolio. Is it part of the process? I guess it is, but it's a long-term trend that's been going on for many years.
Indeed. Mark Yeeles, I mean, you've got a background in robotics automation. I guess we're expecting to see further advances in that as a result of the huge computing power being put behind such technologies. Give us a feel where you see the future from a sort of delivery perspective.
I mean, robotics has obviously been around for quite some time, but I think what we're seeing, and more, I think there was a company called Neura based out of Germany this week or last week, huge company with great opportunity, doing some humanoid stuff that was really, it was quite powerful and used for multiple applications, actually, whether that's in industrial or commercial, in retail as well. But I can see a time where we're going to see more and more, certainly from robotics in our everyday lives as well. Once we get the price point right and the volumes are in that kind of space, I can see that. I mean, I saw something the other day, I don't know whether it was AI generated, where there was a robot as your personal home assistant, all for the good value of $20,000 a year, which somebody seemed to think was quite good value. I don't know, but I think again, probably similar to what Mark said, robotics follows a similar pathway. We just don't know the applications right now that the robotics industry will solve for us. But the one thing I would say is that it's done a fantastic job of taking out laborious, hard, time-consuming tasks out of industry for the best part of the last 30, 40 years. So I'd anticipate, very similar to what we've seen in data center growth, in the move from training to inference, I expect to see the same in robotics as well over the next period, John.
Indeed, it sounds like we're very much across the board in the foothills of what is going to be a technology that transforms the world, and it's been very useful to think about it from four very, very different perspectives, and that there is this vast value chain that is there for investors to potentially tap into. So the AI revolution may have begun. We think about it in terms of software, but we're also thinking about the physical infrastructure behind it, the electricity and the capital investment. It's an absolutely fascinating area. Thank you so much for sharing your thoughts on it.
Thanks, John.
Thank you.
Thank you.
Thank you. Thank you, John.